Have you ever noticed how the biggest economic problems rarely begin with a dramatic event? They usually start quietly. There is no breaking news alert, no emergency announcement, no moment when everyone suddenly realizes what is happening. Instead, the warning signs appear one by one, scattered across the economy, hidden in plain sight. Most people ignore them because life seems normal. Markets continue to move. People go to work. Businesses remain open. But history shows that major turning points often arrive after years of subtle signals that few people take seriously. Today, I want to talk about what may be the warning sign everyone has missed, and why understanding it could matter more than ever for your financial future. When I study history, I don't focus on headlines. I focus on patterns. Over the last several hundred years, empires, economies, and financial systems have followed similar cycles. While every situation looks different on the surface, the underlying forces are often remarkably similar. Countries borrow money to support growth. Debt expands. Asset prices rise. People become more confident. Governments spend more. Investors take greater risks. Everything feels manageable until the system reaches a point where debt grows faster than income and obligations become harder to sustain. By the time the majority recognizes the problem, the warning signs have already been present for years. One of the biggest warning signs today is the growing gap between economic reality and public perception. Many people look at stock market highs and assume the economy must be healthy. But markets are not the economy. Markets reflect expectations, liquidity, and investor sentiment. Sometimes they accurately represent economic conditions. Other times they become disconnected from them. Throughout history, periods of extreme optimism have often occurred just before major corrections. The question investors should ask is not whether markets are rising. The question is whether the underlying fundamentals are improving at the same pace. Another warning sign is the rapid growth of government debt. Debt itself is not necessarily dangerous. In fact, debt can be extremely useful when used productively. It allows businesses to invest, families to buy homes, and governments to finance important projects. The problem begins when debt grows much faster than the income needed to repay it. At that point, the system becomes increasingly dependent on low interest rates, new borrowing, and continuous expansion. History shows that when debt levels become too large, policymakers eventually face difficult choices. They can cut spending, raise taxes, print money, or restructure obligations. None of those choices are painless. What makes today's situation unique is that many people have become accustomed to extraordinary financial conditions. For years, interest rates remained unusually low. Money was abundant. Asset prices benefited from easy financial conditions. Investors learned to expect support whenever markets encountered trouble. But economic cycles do not disappear simply because people want them to. Every cycle eventually reaches a stage where difficult adjustments become necessary. The longer imbalances build, the more significant those adjustments tend to be. Perhaps the most overlooked warning sign is the growing divide between asset owners and non-asset owners. People who own stocks, businesses, real estate, and productive investments have generally benefited from rising asset prices. Meanwhile, many workers have struggled to keep pace with increasing costs of living. This creates a situation where wealth becomes concentrated in fewer hands while a larger percentage of the population feels left behind. Throughout history, rising wealth gaps have often contributed to social tension, political polarization, and economic instability. These developments rarely occur overnight. They build gradually until they become impossible to ignore. At the same time, technological change is accelerating at a pace few societies have experienced before. Artificial intelligence, automation, and advanced computing are transforming industries. While innovation creates tremendous opportunities, it also creates disruption. Some jobs become more valuable, others become less necessary, Entire industries can be reshaped within a decade. History teaches us that technological revolutions generate both winners and losers. The challenge for individuals is recognizing these shifts early enough to adapt rather than react after the fact. Another warning sign appears in consumer behavior. During periods of confidence, people tend to borrow more, spend more, and save less. They assume future income will solve present obligations. This works well as long as economic conditions remain favorable. But when growth slows or uncertainty rises, highly leveraged households become vulnerable. Small changes in employment, interest rates, or expenses can create significant financial stress. This pattern has repeated throughout financial history, from housing booms to credit expansions and beyond. One reason warning signs are often ignored is because human, slow-moving risks. If a storm is approaching, people prepare. When investors hear warnings, they often ask a simple question: if these risks are real, why haven't markets already collapsed? The answer is that timing is incredibly difficult. History does not move according to a schedule. Imbalances can persist for years. Sometimes they grow larger than anyone believes possible. But the existence of uncertainty does not eliminate risk. In fact, uncertainty is often what makes risk most dangerous. The goal is not to predict exact dates. The goal is to recognize probabilities and prepare accordingly. Preparation begins with understanding diversification. Throughout my career, I have emphasized the importance of balancing risk rather than chasing returns. Most investors focus on maximizing gains during good times. Far fewer focus on surviving difficult periods. Yet survival is what allows long-term compounding to work. Investors who protect themselves during downturns often emerge stronger because they retain the ability to participate in future opportunities. Another important lesson is that cash flow matters. During periods of economic uncertainty, people frequently discover that paper wealth and real financial resilience are not the same thing. A rising portfolio is valuable, but reliable income, manageable expenses, and financial flexibility often prove even more important. Those who maintain strong financial foundations are generally better positioned to navigate changing environments. History also reminds us that every challenge creates opportunity. While many people focus exclusively on potential problems, successful investors pay attention to both risks and possibilities. Economic transitions often produce new industries, new technologies, and new sources of growth. Some of the most successful companies in history emerged during periods of uncertainty. The key is maintaining the flexibility to recognize opportunities while remaining disciplined enough to manage risk. One of the greatest mistakes people make is assuming that the future will be either entirely positive or entirely negative. Reality is usually more complicated. Economic systems evolve. Some sectors expand while others contract. Some investments perform well while others struggle. Some individuals adapt quickly while others resist change. Understanding these dynamics allows investors to move beyond fear and focus on preparation. If there is one message I would emphasize, it is this: the warning sign everyone missed may not be a single statistic, a single market indicator, or a single government policy. It may be the belief that conditions can continue indefinitely without consequences. History repeatedly demonstrates that every cycle eventually changes. Debt cycles change, market cycles change, political cycles change, technological cycles change. The people who thrive are usually those who recognize change before it becomes obvious. Today, the world faces a combination of rising debt, technological disruption, geopolitical competition, demographic shifts, and economic uncertainty. None of these developments guarantee a crisis, but together they represent signals worth paying attention to. Ignoring them simply because the system continues functioning today would be a mistake. The future is shaped by trends long before those trends become headlines. So as you think about your own finances, your investments, and your future, ask yourself a simple question. Are you preparing for the world as it was, or for the world as it is becoming? Because the biggest opportunities and the biggest risks often emerge from changes that most people fail to recognize until it is too late. And if history teaches us anything, it is that the warning signs are usually visible long before the consequences arrive. The challenge is having the discipline to see them, while everyone else is looking the other way.